This session is entitled Scalping and Trading Strategies, and I know this is going to be a very, very interesting session for all of us in the audience. All of us are traders at heart. I'd like to introduce Mr. Stuart Cowell, the Head Market Analyst at HF Markets. Let's welcome him to the stage.
Thank you, Rachel. Good afternoon, everybody. This is the deadly session after lunch. As Rachel just said, this is a little bit different. This isn't, excuse me, let's put this down. This is really aimed at retail traders teaching. I'm a teacher by heart, and this is all about scalping. Everybody seems obsessed about scalping. When you ask traders what they want to do, they're not sort of mean reverters, they're not breakout traders. Everybody wants to scalp, and the apparent ease of it is what attracts people. So the issue with any type of trading is, you don't want to look at that, do you? So, 6 key things. Are you designed to be a trader? Are you designed to be a scalper? What is it? Simple definition. People get it mixed up, the type of approach to trading and what scalping is. Some simple 5 points to get started as a new trader, as an experienced trader, somebody that's failed, somebody that's blown an account, somebody who wants to start again. 6 benefits, 6 big risks. As with anything in life, there's no perfect solution to anything. More importantly, what makes a good scalper? Trading, and like what the guys were talking about before, liquidity, it's all about understanding yourself, understanding your company, understanding your risk. Trading is all about managing yourself, whether it's your company, your EA, your robot, whatever it is. It's all about understanding yourself. So what makes a good scalper? Everybody thinks they can do it. Everybody wants to do it. And we'll finish with 3 very simple, very straightforward strategies, which hopefully we've all heard of. So scalping strategies. We tend to be driven by our belief patterns, or we are driven by our belief patterns. And a bear is very difficult to switch to be a bull. We tend to have our mindset, so we tend to sit in one of these 2. So before we get started, we need to understand ourselves. And only you can do that. You've got to look in the mirror and understand what sort of person you are, what drives you, what your belief pattern is. Not necessarily what your religious belief pattern is, but what makes you tick. Because that's by far the most important thing. So are you always optimistic? Are you always looking for the markets to move up? Are you always better when you take long trades than when you take short trades? Or are you the contrarian that's plotting his own course out in the lake, out in the sea? Or the jellyfish that's floating around, looks rather safe and easy, but a great big sting in the tail. So understand yourself first and foremost. So definition out of the book. Short-term, frequent trades, in and out in a matter of seconds. Objective to make small lots of trades, typically just a few seconds. They can hang on for a minute, 5 minutes. Anything over 5 minutes, I wouldn't say that's a scalper. But anyway, we'll come on to what can happen later on. Just because it's fast, it does not mean it's always profitable or easy. And lots of people get sucked into the idea that I can be in and out quickly, it must be easy. Well, it's not easy, it's fast by its very nature. So, a couple of ideas to get going. If you're going to trade, you can scalp anything. Everything is, there's liquidity, as the guys were just saying before, there's liquidity in all markets now. CFDs make it very, very easy to trade. So if you're going to trade, it is fast, you're going to do it manually. Look at one market. If it's FX, look at 3 pairs. Look at the big, deep, liquid pairs. Look at the tightest, busiest times of the day. It's not trade in one direction with the trend. The market isn't trending. Leave it, stay on the sides. Limit your screen time. It can be extremely tiring because you're concentrating a lot of the time. As with all types of trading, the biggest problem is a trader's emotions. Fear and greed are the 2 things that drive the market. Always have, always will. And, whether cryptos disappear or not, like they said in the last session, that will still be the main thing that drives the market. It's one coin, and it's the same side. It's 2 sides of the same coin. Manage your emotions, and always, always, always manage your risk. When your stop loss is hit, get out. Don't stay in. Get out. Don't let a scalp become a trade that you hold for a day or a week. You want to have your stop loss, you want to have your target, get in, get out. We'll come on to it in a minute when we look at some trend trading type scalping approaches. Watch the spread, watch the volatility and the liquidity. Again, just like the guys in the previous session were talking about, down at the retail trader level, it can really hurt, obviously. Because the spread is the spread. If you're only looking to make 3 or 4 pips or 10 pips, a spread of 1 or 2 pips is a huge percentage of what you're trying to make. Lots of people go into that without really understanding. And highly liquid assets, so the biggest forex pairs, the biggest equity companies, tend to follow the rules of range and trending more closely. It's not an exact science, but in general terms. So, why would I want to trade? The biggest one is probably that third point in there. There's no overnight risk. You're out. You've closed your book. So you open your trading platform, your positions, when you come into the beginning of the day. So you're not awake, worrying about open trades. Is it winning? Is it losing? What's going on? How are being stopped out? It's a very high hit rate simply because your targets, excuse me, my voice is going, tends to be quite close. Because you're only trying to make a few pips, you can be quite a successful trader in percentage terms. And a lot of people like that. They like to be winning. They like to be successful. They mightn't make any money, but there are still, a 70 or 80 or 90% winning trades. It depends how some people tick. You can have long winning streaks. It can be a trend following exercise. So you can be in and out 3, 4, 5 times in the space of 1 hour if the trend is running. More importantly, as a retail trader with a relatively small account, you're using less margin because your stop losses are closer, your targets are closer. Obviously, lots of traders don't trade with stop loss. Lots of traders don't trade with a target. They don't remain traders for very long. You can also get lots and lots of experience very, very quickly scalping because you're making lots and lots of trades in the real market, in real time, not in weeks or months if you're an end-of-day trader or trading on 4-hour time frames. And it's very, very easy to adapt if you've got the right mindset. You can get in and out, but you've got to accept that you're wrong. One of the biggest problems most traders have is they can't accept being wrong. They can accept losing because that's part of the game, but they can't accept being wrong. Because you've got lots of trades going on, and because you're only trying to make 3 or 4 pips or 5 pips or 10 pips, you've got to be quite accurate. So you haven't got much room to be wrong. It can be incredibly tiring because you're concentrating, whether you're trading it manually, or you're only trading for like a 20-minute session or a 1-hour session, or even if you're trading from a robot, you still got to be concentrating at all times. And because of the time frame is so compressed, the emotions of trading become completely focused and completely exaggerated. So the fear and the greed gets exaggerated. We get rid of hope and regret. We don't open a position and hope it'll win. We don't regret if we lose. It's just part of business. But we've got to understand ourselves. Obviously, if we're only making a few pips and the spread is the spread, whether we want to make 5 pips, 10 pips, or 200 pips, the cost per trade is much higher because your target's so much closer. The news of the day, if you're not planning your trades, if you're not planning the news of the day, that can suddenly blow out any positions you're out. So economic, political noise can blow you out very, very quickly. And there's a lot of screen time. So the amount of pips on the amount of money you might be making, your exchange and your time for money is quite high as well. So what makes a good scalper psychologically, physiologically? They've got to understand themselves. So if you're not sort of psychologically designed to be a scalper, and lots of people think they want to be because they think it's quick and it's easy and it's over by the end of the day, I've got no overnight risk, you will not move forward. You've got to understand yourself and have an emotional control. You've got to be able to handle pressure well. Lots of people say, I can cope with pressure, that's not a problem. But as a scalper, because you're dealing with money, usually your money, or more importantly, a client's money, the continual and consistent pressure throughout the day, throughout the trades, builds up. So you have this huge, huge cognitive load. Lots and lots of new articles written about cognitive load and being able to change your mindset very, very quickly. Accept that you're wrong 5 seconds after thinking you're going to be right. It's a very difficult thing to do it day after day, session after session, trade after trade. You've got to perform well under stress. It's different to the first one. It's continual and consistent. It's just, again, it's something that builds up over time. And be able to assess changing conditions, being able to adapt to change quite quickly. Again, people don't like being wrong. The market will prove you wrong. The market, you will be wrong. You've got to accept that you lose. And again, most traders can't accept losing, and that's one of the big steps forward any successful trader would say they've done. They've accepted losing and part and parcel of their day-to-day business. So you've got to be able to handle things quite quickly. Obviously, be aware of the time frame you're trading. Look at the liquidity again, what the previous session the guys were talking about. This is obviously the retail session. Obviously, the big depth of liquidity comes in when London opens. It spikes again when New York opens. That's the big liquidity of the day. And obviously, all the fat fingers that usually occur at the end of the New York trading day, the beginning of the Tokyo trading day. Watch the session changeovers and watch any key releases or any surprise news items that suddenly might hit the market and get you out. So, in summary, basically, focus on one market. If you wanted to trade in one direction, you're with the trend, whether that's the hourly trend, the 4-hour trend. Limit your screen time. Control your emotions, that fear and greed. Always bring them to the forehead, to the forefront of your head. And always, 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 always manage your risk and accept that it happens a lot. And again, if you're scalping, you're taking lots of trades, you'll be losing a lot. Always focus on the losing. The winning will come with time. So 3 very, 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 very simple trading strategies. Okay, this can be applied to scalping. It can be applied to longer time frames as well. Very simple, crossing exponential moving average strategy, EMA, exponential moving average first. Heiken Ashi, and then we'll look at pivot points. I like the 5 and the 9 EMA. So the fast one crosses the middle timed one. That's the first trigger. Very, very simple. Works quite well on a 1 minute, 5 minute time frame. So that's either going to trigger a long position if the 5 crosses the 9 from below, and vice versa for a short. If the 5 crosses from above to below, we go short. The entry trigger is when the 21 EMA is crossed. The candle closes or your bar closes above or below the 21 EMA. And then we just trail it, basically. We put our stop loss where the market's turned, and we trail our stop loss up either the lowest low or the highest high, depending on where we're going, of the last 3 candles we count back. It's very simple to employ manually. It's very simple to code and follow the rules. Rules are rules. Again, lots of traders don't accept the rules. They'll accept this setup and then throw it out the window when they start manually trading with it. Very, very simple. This I've taken the wrong screenshot here, but this is using the Bollinger Band, so it's got a 20-period simple moving average on here, but you can, messy chart, I apologize about that. As you can see, the orange trade triggered as the yellow line and the blue line have crossed. We're in the top half of the Bollinger Band here, so we're above the 20-period moving average. We've rallied, we've come back down at the yellow line. Sorry, we come back down at the blue line, got into the yellow line, out at the blue line. Got in again at the next yellow line at 13.32. It's rallied up, hit the 200-period moving average, just happens to be on this particular chart. Spiked higher, out. Short trade, ran a long time. So again, you can either take the trade and stay in, or you get out after your target if you want to use a target of a few pips, 5 pips, 10 pips, and re-enter if the trend is still with you. Okay? Simple turn. Next one was we're in, out. We went up, failed, triggered long, and it's off and running again on that one. So again, we're trailing our stop loss up after that final trigger's gone. So very simple crossing strategy works well on 1 minute and 5 minute charts. Obviously, moving averages, they've been around for longer than I have, and I've been around a long time. They're very simple, they're very easy to apply, they're very popular because of that very nature, and lots of problems with them, lagging. Lots of people hate them, don't like them, too slow, blah, 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 but they work, and they work well enough. As with most strategies we talk about, I get that all the time. What's the best strategy? What's the best time frame to trade? There isn't a best strategy or a best time frame. It's the time frame that suits you as a person and suits you and suits your lifestyle. That's by far the most important thing any trader needs to get right. So it's just an example of, again, how it can run and run and run. So we're talking about scalping, but here it's gone on for about an hour and a half before it's actually turned. So we either get in and get out a few times, or we just add to our position as we move up, as we trail our stop loss up. Second one, Heikin-Ashi candles. Heikin-Ashi candles, I like them. They're very simple, again, clear. See, I've used that word again, simple. They have a particular problem. We'll come on to that in a minute. But Heikin-Ashi, there isn't a direct translation from Japanese to English, but really it means average bar. It looks like a normal candlestick or a normal bar with the open, high, low, close. But the maths is different, okay? So a different formula. So it takes the two previous bars and the mathematics looks a wee bit different. So the key thing is that the following bar always opens in the middle of the previous bar. So again, great for strong trending markets. So we just look at a trend following strategy. This is also quite good, or very good for trending markets. Strongest trends, they have no wick. So interpreting a Heikin-Ashi candle is like a normal candle, but the maths is a bit different. But the size of the body of the candle and the size of the wick, either to the north or the south, or the shadow to the north or the south, the interpretation is exactly the same. So the body of the candle, the size of the body matters. The bigger the candle, the more significant it is. And the size of the wick, again, the bigger the wick, the bigger the rejection. So wick means big wick means rejection, big bodied candle means strength in the direction that we're going. Okay? Because of the maths that creates Heikin-Ashi candles, the live price is often, or is, not often, is always a long way away from the close of the previous candle. So, and some distance from the live price. But what we're looking for as a strong trend is there's no upper wicks on the candle. We're looking to be short. If there's no lower wick or, no lower wick, we're looking to be long. And these can run and run and run. And the clarity of the Heikin-Ashi candles without any other indicators is what particularly appeals to me. So again, this is Euro on the 1 minute. You can see the way I have this set up on a simple MT5 platform. Red is a negative candle, white is a positive candle. There's different ways of interpreting this, different ways of trading. You can simply go from long to short as the color changes, ignoring the wicks, or you could wait until the wick disappears. So at the top there, we've been white, so we take a short position as the candle changes red. But as you can see, the candle at the top there, the body's sort of average size, and the wicks are average at both the same size, bottom and top. So it's a balance. Not a lot going on. The second candle, the small red candle with no wick to the top, that's a positive, negative candle. So that would have been, if you didn't go short on the first candle, you would have gone short on the second candle. The body of the candles, we start to move down the first 5 red candles. That second set of 5 red candles there gets bigger, so the trend tends to increase. So again, you could have got out as we suddenly change. Lots of volatility at candle, whatever it is, 10, round about 23, whatever time that was. Out, and then the following candle was a very positive, strong, negative candle, and that's ran and ran and ran again. So again, as the trends run out, we've got a balance at the bottom. We've got a balanced red candle. We've got a balanced type white candle, but all of a sudden, we suddenly turn around and move up. So it's a very simple way of trading on Heikin-Ashi candles. The caveat of all of this is if we're waiting till the candles close, remember that the closing price is somewhere away from the closing bottom of the candle. So just bear that in mind when we're trading with Heikin-Ashi candles. But it's quite simple, it's quite clear, and it's quite a straightforward approach to trend following, whether you're in the scalping time frame or even in the longer time frames as well. With Heikin-Ashi candles. So, quick review. Large body candles, no wick, we want to be long. Large body candles, no upper wick, you want to be short. Small body candles, upper and lower wicks. Possible trend changes we just saw in that previous slide. Is it gonna work? Yeah, so in the previous slide. So we got no wicks here, that's strong. We got a possible trend change. We went from red to white, didn't happen. Kept going. Balance, 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 and then all of a sudden we flick from red to white, from red to white, and then off and running, and big body candles as that downtrend suddenly broke. Okay? So small body candles, no upper and lower wick, possible trend change. Wait for confirmation and change the candle color. So you can either just follow the colors or use the wicks at bottom on top to decide what you're going to do. Okay? So the thing about scalping and the thing about trading in general, this idea that you really need to know what sort of person you are. If that was, let's go back to this one. This about what's in there. We've gone from 23:37 to the close of the day, so it's not long. Lots of people that could easily represent. It could be a 5-minute candle, it could be an hour candle, it could be a weekly candle. It doesn't really matter. It's the time frame that a trader trades, the time frame that a trader is successful or fails on should be the time frame that fits his personality or her personality, because it fits in with their time frame and their lifestyle. That's by far the most important thing for successful trading, rather than strategies or scalping or mean reverting trading or breakout type approaches. So Heikin-Ashi, simple EMA, and finally a pivot point type approach. There's two ways of doing this. We either bounce from the pivot point, and when I say pivot point, it can be any of the major lines of resistance or support during the day, or we break the pivot point. Okay? So if you apply pivot points to your charts, what you get is basically 7 lines based on the price action of the coming day, based on the price action of the previous day. And obviously the pivot point of the day that is coming is the midpoint. So we have a pivot point, we have a first line of resistance, second line of resistance, third line of resistance, and below that we have a first line of support, second line of support, and a third line of support. Of all the trading days, about 45% of the time, price action will hit the previous support 1 or support 2. So a lot of the previous day's price action takes place between the pivot point and R1 and S1 most of the time. So 45% of the action will take place in that window. Okay? So what we're looking for here is a bounce from any of those lines, whether it's the pivot point, the first line of resistance or second line of resistance, or wherever we are, to take a position. Okay? So we enter when the high or low of the first candle that fails to make a new low or high is broken. So the line is providing the bounce, but we've got to make sure it hits it, bounces from it, and then it's going to go down. The break approach would be hitting it, testing it, and breaking through it and going with the flow again. And again, so long trade, price candle touches any of the 7 lines we're looking at. The subsequent price candle fails to make a new low. So we hit it, doesn't go lower, and then the subsequent price candle breaks the high of the previous high candle, and so we're going to move to a long position. Short trade obviously flips that on its head. Price candle touches any of the 7 points, subsequent price candle fails to make a new high, and the following candle breaks the low of the previous price candle. Okay, so these 3 very, very simple strategies work very effectively on the 1-minute time frame, 5-minute time frame, so it can be applied to scalping. Obviously, I haven't talked anything about risk management. I haven't talked anything about setting targets or stop losses, but these are strategies that work and work quite effectively. Most strategies work. Most trading approaches work. The problem is the trader always. It's the application of the strategy. I've been in rooms teaching, showing people strategies. They have a look at their live feeds. They'll trade. They'll supposedly follow. They'll understand the rules. They'll nod their heads. They'll follow the rules. Yes, we'll all be looking at the same charts. And in a room of 20, probably 15 or 17 of those traders will lose money because they'll decide that what we've talked about perhaps isn't quite right. They couldn't bring themselves to open the trade. They won't put the stop loss in the right place. So faults happen. So it's about you. It's about the application. And then people will say to me, well, let's automate it. Let's write a robot to do this. Let's automate things as much as we can. Again, that minimizes that loss a wee bit, but not perhaps as much as you might think. Trading success is all about mindset and all about understanding yourself and trading the time frame that fits you. Okay? So just going back to pivot point. So here we've had a rally from the pivot to S1. We've hit the first line. We failed to make a new low. And we've bounced from the pivot. That's actually S1, R1. We've hit R1 and rotated down. So we trail our stop loss down. We put our stop loss above our pivot resistance line, support line, wherever it happens to be, and we just trail it down again. Because remember, 44% of all trades will hit that. What we've got at the bottom is a failure of the support line. So this is suddenly triggered short. And we've gone short through. So we've been short, didn't bounce this time, and it's broken through this time. So it's just a follow-up the first trade. So low high, hits a point, trail our stop loss down. We sell on the break of the next, or when it reverses and takes us out. Here it hasn't. We've taken the trade to the bottom of the line. Okay. So thank you. It's a bit short. It's longer than that. So, in summary, let me just go back to ideas of So this says scalping getting started. This could be about any type of approach, okay? So scalping in particular, the big issue is the heightened emotions that come with trading. Emotions are always involved in trading. We can't get rid of them. Lots of people say just forget about it, and you can't because we're human beings. And again, people say, well, we'll automate that. I'll just buy a robot, or I'll copy somebody else. Because it's your money, it becomes much more in the front of your head instead of in the back of your head, and those little voices are always going about worrying what's going on. So what we do, we minimize the risk. So we always try and keep our emotions under check. Okay, don't get too greedy when we're winning. Don't get too depressed when we're losing. A long winning streak is just as bad as a long losing streak. You've got to analyze every trade you take, understand why it won, understand why it lost, and try and accept both as the same outcome. It's very difficult to do it in reality, but again, people that move forward trading, retail traders, will understand themselves better than most, okay? Don't try and trade each and everything. Again, all the previous sessions we've talked about today, we talked about the retail CF broker market expanding all the time, more and more assets coming on. You can't be an expert in everything. A good trading strategy should be able to work across multiple timeframes and across multiple assets. But we all have our own preferences, whether it's stocks or commodities or Forex, whatever it may be. So stick with something you understand and you know. And again, you don't have to try. Again, I can't tell you what to do. But for me, longer time frames means less stress, means easier decision making. And trends can run and run and run. And I'm not talking about even in the scalping time frame. That can be like for hours and hours. In the higher time frame, that can be days and weeks. Look at the massive bull market we've had in the equity market since the 2008 capital crash. The big issue with scalping is this idea of wanting to do it all the time and wanting to be in front of the screen all the time. It's very tiring. It can be very exhausting. And it, again, the fear and the greed just gets exaggerated because of the lower time frames. But lots of people still see the benefits way outweighing the drawbacks. They'll have their, even if they're not actually designed to be scalpers, because they haven't gone through that, but they see the idea of no overnight risk key. They're not in the market. They're getting lots of winning trades because they're only trying to make 5 or 6 pips. And again, psychologically, that's a big hit rate. So, but if you've got a poor risk management system, you can have a high win rate but still not make any money. Flicking a coin, it's 50-50, isn't it? Heads or tails. The next flick of a coin is completely independent of the last flick of a coin, isn't it? As it is with trading. But because we're emotionally attached to it, we can't detach the last set of 5 losing trades from the 6th trade. The last 5 trades have no impact on whether trade 6 is successful. Technically, does it? Do they? No. But emotionally, you have much more bigger baggage with you on trade 6 than you had on trade 1 because you've just had 5 losing trades in a row. That's also the case if you've had 5 winning trades and the next trade may or may not be a winning trade. But emotionally, we're attached to them. And that's the problem. That's always, always the problem. Once you accept that you can lose, and you lose with good grace, and you learn from losing, that's when you can move forward. Most people risk too much when they first start trading, or whether they're experienced traders, beginners, intermediate traders, and they're not getting enough experience because they've risked too much and blown it all and think they can't do it. Or the other extreme, they've had these long runs of winning trades and think they're absolutely invincible. When I first started trading, it was the beginning of the dot-com boom, and I thought I was the greatest trader since sliced bread. And all I was doing was buying stock that was going up because I came from the telecoms business and the internet had just started and tech stocks were just booming. And I thought, this is easy. Another $5,000 there, another $5,000. It just kept going up. Had nothing to do with my skill or ability or anything. I was just lucky. But it took a few months before the penny dropped and realized I was just lucky. So you've got to understand yourself. And again, so scalping has a great appeal simply because there's no overnight risk, lots of little margin, you can get it in and out very, very quickly, and lots of people get attached to it, think they can make money quickly. But again, it's all about you. And if it's not something that you're physiologically designed to do, don't do it. Find something else. Keep away from trading. It may not be for you. So it's all about risk management, benefits, pros and cons, as usual. So there we go. Hope that made sense. The idea of those simple strategies, try them, see if they work for you. Again, they work. Do they work well enough? They work well enough to win, to make money. The problem is, I'm sure you're all aware of a huge survey that was done probably 5, 6, 7 years ago now. 18 million trades were surveyed for traders. And the problem was, although traders were winning about 53, 54% of the time, they ended up losing money. Because for every dollar, for every dollar they won of the 55% of the trades that they did win, they were losing $2 of the 45% of the trades they lost. And that's why people blow their accounts. They get too greedy, they close their winning trades too quickly, but fundamentally, they can't accept losing and won't lose. So they will hang on to losing trades, whether you're scalping in a matter of seconds or an end-of-day trader holding for 500 pips. They can't accept losing. Once you get over that psychological issue, you have some chance of being able to move forward. Okay, I'm just about to run out of time. Okay, so thank you for your time. HF Markets, we've got a prize draw for a signed shirt from the one and only Mr. Neymar Jr. So scan your QR code at our stand, which is just outside, and chance to win that tomorrow. I think we're going to take the draw tomorrow about 11:30. So any questions before I go? My minute's time's up. One question? Sorry, it was a bit messy.
Hello. Hi. Hani. If I coded the system, the three systems for you, if I coded them,
Yes.
made an EA, expert advisor, okay, exactly the way that you are talking about, how to execute, how to enter the market, how to exit, okay? Do you trust the system? And why not you don't trust the system?
Sorry, why don't...
If I make a robot for you to execute
yes.
exactly the trades that you are telling us about, okay?
Yes, yes.
Do you trust the system, and what's the difference between your execution and the system? The system will have no interference with your emotion.
There won't be. There won't be.
So
Yes, there won't be.
why you don't trust the system?
Yes, well, to automate it, write it. I've back-tested these approaches.
My back history of experience in trading, okay, none of the systems that I saw, for example, like similar to this, not exactly this, I tried to code it. None of them will do trades exactly as it was shown on the screen. So on the screen, you see it makes money, it makes hundreds of dollars for you.
Yes.
When you execute it, it's totally different.
That's the risk of trading. That's one of the risks of trading. The live market is different. I just picked those screenshots. They weren't. I could have, if I had my live trading platform, we could do it live now. But actually executing live and getting the fill at the price you want and getting out at the price you want, that's one of the risks of trading. And again, when you're just looking for a few pips as a scalper, you're trying to be in and out in a few seconds, that risk is heightened simply if you've got less margin to play with because you're only playing with a few pips. And again, what I found over time, speaking to thousands of traders, is that people get not sucked in, but they see the appeal of scalping because of the no overnight risk. It's in and out, it's quick, it's easy, it looks like it's easy. But as they execute, when they do it for real themselves, whether it's an automated system or manually doing it, they tend to drift to a higher time frame because they think, I'll hang on to it for 15 minutes, or I'll tell you what, I'm going to be an hour trader. The problem is, if that's not what's fitted in his mind, the problems he got wrong trying to be a scalper and trying to be patient and disciplined in the shorter time frames, he still can't do it in the longer time frames because he hasn't dealt with the main issue, which is finding a time frame that works for him. So the trader that says he can execute in like a short time frame still sometimes can't apply it to like the 1 hour or the 4 hour because he still won't follow the same rules. Because the rules are the rules, whatever time frame you trade.
Excuse me, what is the advantage of doing this manually rather than executing it automatically?
You would argue there isn't an advantage because you're bringing more emotion into the trade.
But the problem is in our emotion. This is why.
Yes, exactly. So you'd argue, let's automate all of it, okay? But then, let's compare a fully automated approach, that simple crossing strategy, to the manual strategy. Sometimes, again, although the rules are the rules, doing it manually, saying, well, actually, yes, the rules have triggered, but the candle wasn't that big. It didn't break it significantly, or there was something else going on. I know, there's some big news coming, or big news is finished. Sorry, I think I've run over time. So,
okay. Thank you.
Thank you. Hope that made sense. We can talk later if you want.
Can I ask you a question? That doesn't work? Nope. Nothing.
I think I'm out of time, actually. Am I out of time? Rachel? Am I out of time? Yeah, sorry.
1, 2, 3. Okay. Hello. So I have a question about the strategies. May I
Yes.
ask you to open a previous slide, please?
Which?
Yep. So there are two breakthroughs through the bottom line. So how do you know if it's broken or not? Like, when do you enter? Is it fixed value, like 3 pips, then we enter, or is it based on some standard deviation, for example, 2%?
No. I made it try as simple as possible. That it just simply touches the first bar. The lower, the second candle didn't make a high, made a low low. The third candle didn't make a high or a low low, so we're going short, and that's it. Again, that's something that could be programmed. Obviously, you'd have to update it. And again, the pivot, but there's lots of different types of pivot points. You know, some are better than others, but the most common are the standard ones you get on your MT4 platforms. Some people like Woody's. So again, but try it, see how it goes. But remember, as I said, most traders are okay. Most traders will make more winning trades than losing trades. The problem is most traders also end up blowing their account because their risk management and their money management, another one of my big mantras, is all out of the window. And they let emotion and discipline and all that sort of good things, again, out of the window. So whether you're a scalper or an end-of-day trader, trade the time frame that fits your personality. Sorry, I've run over quite significantly.
Excuse me. Hi.
Sorry.
I have comment. I think disadvantage of scalping make more stress because maybe you have a full-time job.
Yes.
This is a disadvantage.
Oh, well, if you've got a full-time job, you can't. You're not. It depends when your day is. If you're on the, if you're in London and Europe and Africa, you're in the deepest liquidity is the London session. If you live in Asia, obviously it's less liquid in that session. But yes, you as that example showed, that last one was late at day. It's 2,300 hours, so it's the end of the day. You can scalp. You can do any trading strategy. Any time of the day, any day of the week. But some days are better than others. Some time frames are more liquid. Some time frames are less liquid. I think I need to. Do I need to get down? Yes. I think I've overrun. I've overrun. We'll chat afterwards. Okay. Thank you, everyone. Sorry.